Well, good afternoon. Happy Friday, August 22nd. Mark Milam here, your mortgage professional. Wow, all eyes this week pointing to 10 a.m. today when the Federal Reserve Chairman Jerome Powell was set to speak in front of the media at the conclusion of the Jackson Hole Symposium. This is an annual symposium where the brightest financial minds, not only the United States, but also around the world, meet to discuss things like inflation and economic policy and labor. And all of these things impact not only the stock market, but the bond market, mortgages, or just long-term bonds, which means we pay special attention when the Fed is talking. So of particular interest today was the divergence that the Fed is seeing between inflation, which is rising, and the labor market, which appears to be softening. And which would the Fed prioritize? After all, our Federal Reserve has a dual mandate. Number one is to promote maximum employment. That's a focus on labor. But number two is to keep inflation in check, price stability, right? To keep inflation near the Fed's target rate of 2%. And we've seen inflation start to tick up here over the past few months. So the Fed kind of caught in a difficult position here. And in the past, the Fed has prioritized inflation over labor. But that wasn't the case today. And because the Fed had a shift in their language, we ultimately saw mortgage rates improve on the day, and the stock market just had a banner morning and a decent afternoon. Let's flip the screen around here and take a quick look at the live mortgage-backed securities. Mortgage-backed securities up on the day. That means mortgage interest rates are headed lower. You can see this is the candlestick chart reflecting as such. And we'll go over here and take a quick look at a headline from CBS News. The Fed Chair Jerome Powell signals a path to rate cuts at the Jackson Hole speech. And I've highlighted a few sections for you. Down here at the bottom, it says risks to inflation are tilted to the upside and risks to employment are tilted to the downside, a challenging situation. There's that conundrum we talked about, that the Fed is really caught between serving their dual mandate and they've got information that's pulling each of these items in a different direction. So which one are they going to prioritize? Powell's remarks signal that the Federal Reserve is likely to cut rates at its next meeting on September the 17th. That would mark the first reduction in interest rates since December of 2024. And then down here at the bottom, the Fed essentially acknowledged the downside risk to employment after a shocking July jobs report. And I think that's really the difference here, is we're talking about differences in degrees. Yes, inflation is ticking up, but it's ticking up rather slowly. We're not seeing 7, 8, 9% inflation. We're seeing it go from 2.5 to 2.7%. What's happening with labor is starkly different. Honestly, we're seeing weak non-farm payroll report, weak labor creation, but the revisions we're getting to these reports that go back 1, maybe 2 months prior, we're seeing massive revisions to the downside to show that the labor market is actually contracting. That's where the real danger lies. And you can't pay too much attention to the unemployment rate, because the unemployment rate is very much influenced by labor force participation. The fewer number of people who are actually looking for work, it helps suppress that unemployment rate. So while unemployment might look good at 4.1%, if we had a labor force participation rate like we had back in May, it would actually be closer to 5%. And that's troubling for the Fed, and ultimately looks like it's pushing them towards opting to prioritize labor now over inflation. And that September 17th Fed rate cut is very much on the table. In fact, futures traders now forecasting about a 90% chance that the Fed is going to cut the Fed funds rate by a quarter of a point come September 17th. That's something we'll keep our eye on. Now, listen, the reason you're reading headlines and you're hearing news that mortgage rates have been improving over the past couple of weeks, listen, the Fed hasn't cut the Fed funds rate yet, so why is that happening? Well, mortgage bonds are traded every single business day in the bond market, and ultimately traders are now anticipating that rate cut come September 17th. Think of mortgage rates as the first car in the roller coaster. Think of the Fed funds rate as the last car in the roller coaster. So don't pause your home search waiting on September 17th. The gains that we're seeing, the improvement that we're seeing, is already reflective of what the market anticipates will come in about a month. Let's also talk about existing home sales versus new home sales, because we've got something really fascinating happening here. And I'll call your attention to some data. In the 306 months since the end of 1999, so really for the entire, so far, millennia of the 2000s, the existing home sales price has exceeded that of new home only 9 times, only in 9 months. And that stands to reason, right? Something new a new car, a new boat, a new house would be more expensive than something old, right? That stands to reason. You wouldn't typically see something old being priced over something new. And that has stood to reason that only 9 times out of 306 months have existing home sales exceeded that of a new home. But 7 of those 9 times have been seen over the past 13 months. In other words, in the past year, we've really gotten the bulk of that odd anomaly occurrence. And as of June of 2025, the median single family home sales price was, this new single family home sales price was 401.8. The median existing family home sales price is 429.4. And you can see on this graph what an anomaly that is. Normally, your new home prices, that orange line, would hover above existing home prices, but we're starting to see the opposite now. Well, why is that happening? Why are we seeing existing home prices go up, but new home prices are going down? Well, some of this is around inventory. Builders have been building and they've been in really good shape for the past couple of years, but so far in 2025, it has not been a banner year for builders. In fact, we get a National Association of Home Builders index, a confidence index, 0 through 100, with 50 being right in the middle, like neither optimistic nor pessimistic. And that index is hovering around 32 right now. So builders very pessimistic due to high interest rates, weakening labor, the high cost of goods that they're able to sell their homes. And listen, builders are not like existing home sellers. They have to move inventory. This is a business for them. If you're selling your home and you're not getting the price you want, well, you just take your home off the market. It doesn't represent a business loss to you, but it does for those builders. So they are forced to slash sales price to move inventory, even if it just means they're going to break even, because not doing that and holding that inventory on the books is the worst thing they can do. So we find ourselves in this really unique period of time where new single family home sales prices are actually lower than existing single family home sales prices. If we take a look here at the actual transactions, boy, existing home sales are way down, meaning inventory is probably way down, and new home sales, while still down, are not down near as far over the long haul as you might see with existing home sales. This is just yet another outcropping of what happened during the pandemic. This push by the Federal Reserve and by the administration at the time to drive interest rates to those historically low levels locked in so many existing home owners that are not listing their homes for sale. You know, when you have less supply of something, you see the price of it go up. And the exact opposite now has happened with new home construction. We're seeing inventory in that new home construction market rise, and the inventory is not selling as quickly as it used to. So it's left the builders with one option, and that is to begin to cut price. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam at highlandmtg.com. Have a good weekend.